Today on the FinTalk channel, we're talking about Tesla.
We really are.
And I want you to imagine something for just a second. Like, imagine finding out that the supposedly straightforward car company that invested your hard-earned money in is quietly funneling $2 billion into a private space program.
Right.
Hoarding almost $1 billion in Bitcoin, and suddenly trying to build its own microchips from scratch.
Which is wild.
Right. You are never going to see that in some glossy PR brochure or, hear it pitched to a sleek product reveal. But it is exactly what we found buried in a massive, legally binding document today. So welcome to this deep dive.
Yeah, and it's a prime example of why we always look past the headlines. Today's source material is just one single, really dense document. It's Tesla's Q1 2026 Form 10Q.
Yeah.
Filed with the SEC for the period ending March 31st, 2026.
And we are definitely taking a strictly professional investor tone today because the mission here is, well, it's critical. We aren't just skimming a balance sheet. We're trying to decode a massive, almost unprecedented corporate evolution. Like, based entirely on this legal filing, we have to figure out if we are evaluating an automaker, a clean energy giant, or a sprawling artificial intelligence and robotics ecosystem.
Yeah, and the reason the 10Q filing is so vital for this kind of analysis is, frankly, the legal liability attached to it.
Right. They can't lie.
Exactly. Press releases, earnings calls, tweets from executives, those are all wrapped in marketing hype.
Yeah.
But the SEC forces a company, under penalty of law, to declare the unvarnished truth.
Yeah.
They have to state exactly where their capital is flowing, the literal mechanics of their liabilities, and the quantifiable risks threatening their survival.
So let's just start with that unvarnished truth, specifically the top-line financials and what I can really only describe as a completely staggering war chest.
That's massive.
So the baseline Q1 2026 numbers are officially out. Total revenues hit $22.387 billion.
Which is up 16% year over year.
Right, up 16%. And if we drill down into the automotive sales, that segment specifically jumps 20% to $15.47 billion, largely driven by a 10% increase in cash deliveries.
Yeah.
Which, just for context, that translates to 358,000 consumer vehicles delivered in just 3 months.
And while top-line revenue shows, market traction, as an investor, you really look to the balance sheet for the survival metrics.
Right.
And the liquidity pool sitting there is just immense. They closed the first quarter with $44.74 billion in cash.
Wow.
Cash equivalents and short-term investments. I mean, that is highly liquid capital. And just as an interesting side note.
Oh, yeah, the Bitcoin.
Yeah. Buried in the digital assets section, they are still holding 11,509 Bitcoin.
Which is valued at what, like almost 800 million?
To 786 million at the end of the quarter, yeah.
Okay, let's unpack this.
Yeah.
Because, wait, you're telling me they increased automotive deliveries by 10% in this current environment?
Yeah, they did.
Because the filing explicitly mentions this is partly due to localized price adjustments, meaning, they cut prices to move metal.
Exactly.
But borrowing costs for consumers are still incredibly high right now. Normally, when a car company slashes prices to drive sales volume in a tough macro environment, their profit margins just absolutely bleed out.
Right, they tank.
Yeah. That violates basic automotive economics. So how is that mechanically possible here?
Well, it sounds impossible until you look at the raw material inputs and the manufacturing efficiencies they've achieved. The data shows their automotive gross margins didn't drop at all.
Wait, really?
They actually increased from 16.2% in Q1 2025 up to 21.1% in Q1 2026.
They increased margins by almost 500 basis points.
Yeah.
And just for context for you listening, a basis point is 1/100%. So a 500 basis point jump is a full 5% increase in profit margin.
Right.
Entirely while adjusting prices downward to consumers. That's insane.
It is. But the filing attributes this to a highly favorable sales mix, massive reductions in raw material costs, like think battery metal stabilizing, and some one-time benefits related to tariffs and warranty adjustments. So it proves their manufacturing floor is just relentlessly efficient. But what's fascinating here is how they are actually choosing to deploy that $44.7 billion.
Right.
Because they aren't just hoarding it. And they certainly aren't paying it out as a traditional dividend to you. The 10Q reveals a highly unusual allocation in March 2026.
Oh, this part.
Yeah, a brand new $2.0 billion equity investment straight into SpaceX.
Let me just stop you there. A publicly traded company is taking $2 billion of shareholder cash and investing it into the CEO's privately held aerospace company.
That is the reality on the balance sheet, yes.
Yeah.
They're categorizing it under the equity method of accounting.
Which means what exactly for the listener's portfolio? Like in plain English.
It basically means that because the CEO of both companies is the same person, Tesla has, quote, significant influence over SpaceX.
Okay.
So from an accounting perspective, Tesla will now record its proportional share of SpaceX's net income or net losses directly onto its own income statement.
Wow.
So from an investor standpoint, it means the financial firewall between the CEO's various companies is essentially dissolving.
Yeah.
Tesla is actively deploying your invested capital to fund a separate piece of the CEO's broader technological empire.
So you have $44 billion sitting there, effectively losing purchasing power to inflation, and Wall Street typically expects you to, return that as a dividend or buy back stock.
Right.
But instead, Tesla decides to double down on a massive gamble, and that's where the capital expenditure section of this 10Q gets really wild.
Oh, it's unprecedented.
Yeah, this brings us to a projected spend that is frankly jaw-dropping. For 2026, Tesla projects its capital expenditures to exceed $25 billion.
$25 billion in a single year. Just to frame that, there are legacy automakers whose entire total market capitalization isn't much higher than that single-year budget.
Right, and the filing details exactly where that money is going, because they aren't just building more gigafactories to churn out sedans.
Wow.
The capital is aggressively targeting artificial intelligence compute infrastructure. They're expanding these massive Cortex clusters at Gigafactory Texas. They're building out massive data centers. And this is the part that really blows my mind. The filing states they are investing in semiconductor fabrication.
Yeah, their own chips.
Plus, they've started pilot production of the Cybercab robotaxi and are prepping for large-scale production of the Optimus humanoid robot.
Right.
And just to cap it all off, there's a subsequent event from April 2026 where they agreed to acquire an unnamed AI hardware company for up to $2.0 billion in stock.
And if we connect this to the bigger picture, the logic behind that massive spend becomes pretty clear. It's actually a survival mechanism.
A survival mechanism? How?
Well, Tesla is in a total arms race to solve real-world artificial intelligence, specifically full self-driving and the robotaxi network.
Okay.
And the absolute lifeblood of that AI development is raw compute power. What is a Cortex cluster? It's essentially a supercomputer, a massive farm of servers dedicated entirely to training the neural networks that teach cars how to drive and robots how to walk.
But I have to push back on the semiconductor fabrication part. Building a chip fab is insanely capital intensive.
Oh, absolutely.
And it requires a level of microscopic precision that is just completely different from bending metal and assembling batteries. How is that not a massive ego-driven distraction?
It's a calculated risk against a known bottleneck. Right now, the entire global tech industry is bottlenecked by the availability of specialized AI chips.
NVIDIA, mostly.
Exactly. And if Tesla relies entirely on third-party silicon providers, they're entirely vulnerable. They could be priced out by competitors or simply waitlisted.
Right.
It's like a restaurant deciding that to guarantee the best meal, they can't just hire a better chef. They have to go buy the farm, breed the cows, and forge the kitchen knives themselves.
That's a great way to put it.
Building a semiconductor fab means Tesla doesn't just want to write the AI software. They want to own the physical atoms that process it.
So they're essentially positioning themselves against big tech, not big auto.
Precisely. They are insulating themselves from supply chain shocks. The $25 billion spend is the upfront cost of shifting to a service-driven business model.
Oh.
Selling you the car is just the entry point now. They want to sell you the ongoing AI software subscription, the autonomous cybercab rides, and eventually, the humanoid robot.
But to execute a pivot, this reckless or visionary, depending on your perspective, you need a heavily incentivized leader at the helm.
Definitely.
You can't do this with a CEO who just wants a safe quarterly bonus. And that leads us deep into the compensation labyrinth outlined in the 10Q.
The legal and financial maneuvering detail here regarding this CEO's pay is really unprecedented in corporate history.
Yeah.
It involves court reversals, massive equity plans, and incredibly complex accounting rules.
Okay, let's trace it for the listener. First, the document formally resolves that massive legal drama we all watched play out. The Delaware Supreme Court officially reinstated the CEO's famous 2018 Performance Award. But suddenly handing someone billions of dollars in stock options triggers a monstrous tax bill. So to prevent the CEO from dumping millions of shares onto the open market just to pay the IRS, The board signed an implementation agreement in April 2026.
And that implementation agreement is critical armor for current shareholders.
How so?
It enforces a strict no double-dip principle, meaning the CEO had to instantly forfeit a massive 2025 interim award that had been set up as a backup plan. Furthermore, to access these 2018 shares, the agreement legally binds the CEO to a 5-year holding period.
Wow, 5 years.
Yeah, they cannot immediately cash out.
And
And crucially, it requires the CEO to remain in continuous service at Tesla through at least January 2028.
So he is totally locked in.
Exactly.
But that's just the resolution of the past pay package. The 10Q then outlines the new 2025 CEO Performance Award, and it offers 423 million shares spread across 12 tranches.
Yeah.
And the milestones required to unlock those tranches. Here's where it gets really interesting. These operational milestones read like a sci-fi novel's table of contents.
They absolutely dictate the roadmap of the company for the next decade.
So to unlock the shares, the company has to hit targets like, get this, 1 million robotaxis in commercial operation, 1 million Optimus bots delivered, 10 million FSD subscriptions. They need adjusted EBITDA to hit $400 billion.
Yeah.
And just so we are all on the same page, EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
Yeah.
It is essentially the raw cash profit a company generates from its operations. To hit $400 billion in EBITDA means Tesla would have to generate more raw operating cash than Apple and Saudi Aramco combined.
Yeah.
Oh, and the market cap milestone scale all the way up to $8.5 trillion.
The scale is almost incomprehensible for a traditional manufacturer.
Yeah, if you're listening to this right now, you might be rolling your eyes at an $8.5 trillion valuation. That's roughly the GDP of several major countries.
Exactly.
So how do the auditors even sign off on putting that in a legal SEC document without treating it as a total PR stunt?
Because SEC accounting rules do not care about PR stunts. They care about mathematical probability.
Okay.
Under the rules for stock-based compensation, Tesla is legally required to record a financial expense on their books the moment an operational milestone is deemed, quote, probable of achievement.
So what do the accountants actually think is probable? Like, out of the millions of robots and autonomous taxis, what is considered real today?
Well, as of March 31st, 2026, the 10Q explicitly states that only one of those operational milestones is legally deemed probable.
Just one. Let me guess. It has nothing to do with humanoid robots.
Correct. It is the most traditional automotive metric on the entire list,
Selling cars.
delivering 20 million Tesla vehicles. Because the auditors believe that is probable, Tesla has recognized a massive $9.97 billion stock-based compensation expense that will slowly bleed into their income statement over the next 9.4 years.
Okay, but what about the rest of it? Like the 8.5 trillion market cap, the millions of bots?
The document clearly categorizes those as not probable for now. And that represents anywhere from $105 billion to $120 billion in unrecognized compensation expense just waiting in the wings. So this raises an important question.
Yeah.
How are you, the investor, pricing in the probability of this robotic future when the company's own accountants are stating that only the traditional cars are a sure bet?
That is a massive disconnect. You are investing in a company projecting a completely automated, silicon-driven future, but they are currently being financially graded on the realities of bending metal and selling cars.
Exactly.
Which brings me to the obvious counterweight. This all sounds incredibly ambitious, but what could derail it? We have to weave in the immediate macro risks that the 10Q warns us about, because those $44 billion in cash are not invincible.
No, they aren't. And the risks disclosed here are severe and very present day.
Right.
First, the filing details the ongoing Ninth Circuit appeal regarding the massive class action lawsuit over full self-driving capabilities. That legal battle is expected to drag through late 2026.
And explain why that specific lawsuit matters so much to the pivot we just talked about.
Because if the courts rule against Tesla or issue injunctions regarding what FSD is legally allowed to do versus what was promised,
Oh, I see.
it fundamentally breaks the software as a service revenue model. If you can't charge a monthly subscription for autonomy, The massive data centers and Cortex clusters you just spent billions on suddenly have a much lower return on investment.
Yeah, that makes sense. And then there's the physical reality of building things. The filing notes ongoing pressures from inflation and interest rates, which directly suppress consumer demand for financed vehicles.
Yes.
But I want to zero in on the supply chain risk they highlighted regarding the Supreme Court's February 2026 ruling that invalidated certain IEPA tariffs.
Right, the tariff situation.
Now, we aren't taking any political stance here on whether those trade policies are right or wrong. We only care about the operational mechanics.
Absolutely.
How does a tariff ruling threaten the tech pivot?
Well, it threatens the pivot because building a $25 billion tech infrastructure requires a seamless global supply chain.
Right.
You cannot build an advanced semiconductor fabrication plant in Texas if sudden, unpredictable shifts in tariffs suddenly freeze your access to specialized global materials or machinery.
Ah.
The filing warns that while Tesla might be eligible for refunds on past tariffs, the shifting trade policies dramatically complicate their ability to forecast costs.
Yeah, you can't budget for that.
Exactly. When you are trying to vertically integrate everything from lithium mining to silicon etching, supply chain bottlenecks can create billion-dollar cost overruns overnight.
So what does this all mean? We started this deep dive by asking if we are evaluating an automaker, an energy company, or an AI ecosystem.
Yep.
The truth buried in this Q1 2026 10Q is that Tesla is desperately, aggressively trying to mutate from the first into the third.
Without a doubt.
Whether you are a seasoned portfolio manager analyzing your exposure or just someone endlessly fascinated by how technology reshapes society, understanding Tesla today requires you to look way past the car sitting in traffic. You have to understand the mechanisms behind the $25 billion flowing into Texas silicon foundries. You have to grasp the raw compute power of those Cortex clusters, the equity tethering to SpaceX, and the absolutely wild trillion-dollar incentives locking the CEO into the driver's seat.
It really is a corporate mutation that has no real historical precedent.
Ben.
And I want to leave you with one final lingering thought to mull over when you close out of this deep dive.
Okay.
We spent a lot of time on those 2025 compensation milestones, the millions of autonomous robotaxis, the humanoid robotic workforce, the massive scale of energy storage.
Yeah.
If Tesla achieves even half of the milestones embedded in that legal document, it ceases to be an automaker entirely.
That's fair.
The question you have to ask yourself as an investor isn't how many cars will they sell next quarter, but rather, what happens to the global economy when a single corporate entity controls the autonomous transportation grid, the physical energy storage infrastructure, and a scalable robotic workforce?
Yeah. You are no longer just evaluating a balance sheet. You're evaluating the architecture of the future and deciding if you want to fund the foundry that builds it. Thanks for joining us on FinTalk.